Hi, my name is Stuart and welcome to the Investopoly podcast. Our goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. Okay, let me get into today's Q&A episode, and the first question is from Alan. Alan's written some fabulous feedback, and I'm going to read it out just because he's gone to the trouble of actually generously sharing his feedback. So Alan writes, having listened to your entire series, I'm well aware of the volume of positive feedback it receives, and as such, the relative insignificance of any one such piece. But let me indulge you anyway. It's fair to say I've shopped around when it comes to selecting a podcast to enhance my financial literacy, and yours is a true standout amongst many. I'm grateful for the time you put into each episode and to receive contemporary, incredibly measured and considered information, humbly and intelligently presented in a manner that truly resonates. It's truly a wonderful service you provide free of charge, and I can't thank you and your team for that support enough. You've no doubt improved the lives of many and deserve all the accolades and good wishes that come your way. So, that is probably the best bit of feedback I have ever received, probably in my entire lifetime. And I thank Alan for generously sharing that feedback. It means a lot to me. As I record this episode, I'm approaching 2 million total listens, which is a big number and, something I never imagined really when I started the podcast a long time ago. And the good thing is the listens each month are climbing steadily, shooting the lights out. And it's ranking well, the podcast, ranking well to, some people that have, a far greater reach than I do, which is fantastic. Each year, I sit back and think, wow, that was a pretty good year in terms of podcast content. There's tends to be, a handful of podcast episodes that I'm particularly proud of in any given year in terms of, I guess, testing conventional wisdom or insights and analysis that I haven't seen before. And, then I think, oh God, pressure's on. What am I going to come up with this year? I've got to find the topics to think about and write about and so forth. So I'll keep doing it. I enjoy doing it. I'm working on one at the moment, which I'll probably publish in a couple of weeks' time, that has taken me a lot of mental energy and time to really think about. But anyway, it's interesting. It's enjoyable. Thank you so much for listening. And thank you so much, Alan, for your tremendous feedback. I don't want to turn this into, an exercise of patting myself on the back, but I really feel like if people go to the time and trouble of writing such feedback, I should certainly acknowledge it. Anyway, let's get into Alan's situation because he's shared his situation. He's got a couple of questions. Okay, so I'll just sort of summarize it. Alan is partner, 37, combined incomes of 225 plus 150. So they're the two spouses' incomes or two partners' incomes. Two young children, both currently in daycare and they're currently renting. Own one investment property in outer Brisbane, Ipswich, worth around 625,000, with a $180,000 loan renting for $400 a week, now fully offset. Okay, so I think the loan is fully offset, so no debt. Have share investment accounts in diversified ETFs through a wrap platform of 670,000. Have 900,000 in super under a defined benefit scheme. So, great super. Wife has about 150,000 in super, currently held in a wrap platform. We have approximately $500,000 of cash in a high interest savings account, and we have about 40,000 in a rainy day account for unforeseen general expenses, and have no other debt. We could reasonably afford to borrow around $1 to $1.2 million. Short-term goal is to buy a family home, possibly in Brisbane or Canberra based on work, in the next 1 to 2 years with a view to raising family there. Long-term goal, ideally retire by 60, execute a downsizer strategy, say in 20-25 years when the kids eventually leave home, and could continue to build wealth outside super until closer to 50, then move much of our wealth inside super as possible. Yes, good strategy. Okay, so first question Alan's got is, how should we go about determining how much to spend on a family home and what assets should we consider using to fund the purchase and or reduce holding costs? So, as I was reading through Alan's sort of financial summary, I was thinking 37, ostensibly got no debt, very healthy super, a lot of cash in high interest saving account doing nothing. But I get why it's doing nothing, because their shorter term plan is to go and buy a property. So I get that. Very healthy amount of growth assets, but really no gearing, which is not ideal for someone that's 37 looking to retire at 60, got 23 years gearing, between now. And that's the key question to ask here. What can Alan do today so that he's much financially stronger in 23 years? And particularly in 33 years, that's 60 and 70. I know it feels like a long time horizon, but that's the best thing to ask. He's got defined benefit super and talking about buying home in Brisbane and Canberra. So I'm going to assume he works for the public service, maybe even Defence Force or something like that. Doesn't really matter, but I'm just going to assume that's the issue here, or what's going on behind the scenes, I guess, behind the numbers. So Campbell Wallace, who co-hosts this podcast, and I were having a conversation yesterday about this topic, about determining how much you should spend on a home. And in fact, the client we were discussing was considering upgrading their home. I can't remember the perfect numbers, but I think it was like from 2 to 5 mil or something, or 2 to 4.5. So substantial upgrade, right? They could afford to do that, from an income and expense perspective and asset perspective. So it was doable. It's just a question of whether they should do it. And what we were talking about was that if they made such a substantial upgrade in home, it's likely that it's going to absorb most cash flow, well, really between now and age 65, because it's going to then give rise to about 2 million or north of 2 million of non-deductible debt, which is a pretty hefty home loan, right? I'm not saying it's too high, because in some circumstances that's okay. But for them, and for most people, in most people's mindset, it's a pretty hefty home loan. So even if they could afford to make the repayments on the home loan, whilst making a little bit of extra repayments and still invest in other assets, they're doing regular share investing at the moment. So the question is, would we keep that regular share investing going? The problem is that most people in that circumstance would say, no, I'm really keen to focus on debt reduction, especially since I've got such a high home loan, which is the right approach. And I would honestly, personally, I would probably take that approach as well. But that's more of an emotional decision than a financial one, because really $2 million home loan seems like a lot today, but in 20 years' time, it's not going to be that much. Inflation really eats away at it, which I'm not saying that we should just ignore home loan debt and never worry about, how much we're borrowing, but it's just an observation. I mean, I started this business back in 2002. And if I had a client borrowing $1 million, whether it was for home or investment, certainly for home, it'd blow my mind away. But especially for investment, that was a huge number. I mean, $1 million is a lot of money, of course. But relative to average home loan size now, it's not that big a deal. That's what I'm saying. That's short of 25 years. It's a long time, but it does happen that a big home loan today isn't such a big home loan in the long run relative to assets and relative to growth assets, right? What is he super going to do? Alan Super, for example, in this situation, this question, what will his share portfolio be in 20 years? Because at the moment it's $670,000. So conceivably, if he's contributing, and certainly if it's going to compound, you would hope that's going to be probably around $3 million or so. So you've got to put all this sort of stuff in context. Anyway, the strategy of thinking about a home loan size is really thinking about what is the strategy and what is the consequence of those decisions. So, if we do end up getting a really big home loan, let's say for this client that Campbell and I were talking about, they're going to be reluctant to invest in other growth assets, even though they probably still should. And that isn't ideal, because then all their wealth will be really centered in the family home. And whilst you could downsize in the future, there could be a bunch of reasons why you might not want to do that in the future. And it's not an ideal strategy that, to fund retirement, I've got to sell my home. Again, it's a strategy that can work on paper, but it might not always work in practice. I'd much prefer, or at least put it this way, a strategy that doesn't necessitate me downsizing is a better strategy. So coming back to Alan's question, how do you work out? Well, sorry, I should say the other comment I wanted to share, which is what I was talking to Campbell about, is that if these clients upgrade to $5 million, I'm pretty sure it's going to be a fantastic decision in isolation. It's going to be a fantastic decision for them both on a financial perspective and a livability or enjoyment perspective, because I look at it and say, okay, yeah, they're going to sell this. Their existing home is on a relatively busy main road. So what we're going to be doing then is selling that property and actually then buying a much better property. And we're investing more and we're buying that property, I mean, almost certainly at the low point in the market within Melbourne, where relative value or intrinsic value is very attractive. So I reckon in 20 years' time, if they did it, in 20 years' time, as I said to Campbell, I reckon we'll look back and go, wow, that was, they've shot the lights out financially as a result of that decision, remembering that, there's no capital gains tax. And then from a lifestyle perspective, being a larger family home, there's some extenuating circumstances in terms of why they need more room and why more room would improve their standard of living. But being in a great location with a great house, with great amenities, close to great schools, close to family, all these sorts of things, it's going to improve, have material improvement in their life. So there's so many sort of moving parts to these decisions. It kind of shows how important it is to explore it and to potentially get advice around it. So if I come back to Alan's situation, the way I would describe Alan's situation is that I would say he's certainly relative to income. He's well in front of where I'd expect someone to be, both on that age and based on that income as well. So, which means he's done all the hard work, right? He's done hard work over the last 10 years to really save, invest well, make smart decisions. It's around the podcasts he listens to. I don't know if I can say that. So, kudos to Alan. You're off to a great start. To my mind, because that's the thing, right? I always think about, okay, how much can we spend on a home without compromising our ability to invest in other assets to be able to fund retirement? So putting it differently, can we build a strategy here that doesn't require downsizing the home? Now, I know Alan has mentioned around downsizing. That's just probably from a practical perspective. When kids move out, the home's too big, let's go to something smaller. I get that, but I would rather that be a choice rather than a necessity from a financial planning perspective. So really the question is, how much debt can Alan take on and how much does he really need to contribute to his investment asset base? The thing with a defined benefit super fund, I'll just very quickly, so for the people to understand defined benefit, there's two types of super funds: defined contribution, defined benefit. Defined contribution is the balance is defined by the amount of contributions you make. That's your standard everyday garden variety superannuation account. We make contributions, you earn returns, that's your balance. Defined benefit is a formula, normally multiple of final average salary. So the average of salary over the last 2 or 3 years of your working life. And the multiple is dependent on whether you've worked full time and how long for. And the longer you stay with the employer, the larger the multiple is. The point of mentioning this is that there's no market risk. So the only risk is remaining at that employer. And if you're able to remain at that employer for, well, until say age 60, for example, you can very clearly work out what your benefit will be. And there's no market risk. Doesn't matter what happens to returns over the next period of time. When I have a client that has defined benefit super, arguably I can afford to take more risk with other investments because one part of their wealth does not have any market risk. So that means that I can keep the wrap platform, that's the investment share account, that's 670,000. I can keep that all growth. Arguably with the wife super that's also on a super wrap platform, I would go all growth with that as well because we've got the defined benefit super. And I would say with the super's about $1 million, and then we've got 670. So let's call it just 1.7 roughly in terms of investment assets at the moment. So in 20 years' time, that 1.7 should be maybe 6 million. 6 million in 20 years' time might be worth about 3.3 today. More than 3 million, you're going to be able to spend $120,000 a year perpetually. So that'll be enough. He's already laid the groundwork at age 37. Now the only component, the ingredient needed for him to be able to fund retirement is time. The capital contribution, that part of the ingredient is kind of already done. So therefore, what we could say is that Alan could spend whatever he could afford to repay over the next 20 years, so that the home loan's gone by age 60. And so he can push the envelope that hard, I think. So I think what I'd say is that I think he's going to be restricted by borrowing capacity, not ability to borrow or ability to repay over the next 20 years, because I get the sense that he's pretty good at cash flow management. So I think it's really borrow as much as you can so that you can get the best quality asset, both from a wealth perspective, but also from a lifestyle perspective. So you've got 500,000 in cash plus your borrowing capacity, which you say you can afford to borrow, say 1.2. Maybe you can actually go a little bit more aggressive than that, but that gives you 1.7 in terms of a total budget for the home. So I think I would express the budget as say $1.5 to $2 million. But really what I'd try and do is I'm not saying that people should go and spend as much as possible, but typically the higher the budget, the better quality the property, both in terms of location and also in terms of, the dwelling itself. So the improvements on that property, and that's important from a home perspective. So I think the answer is I wouldn't worry too much about your ability to invest at this stage because you've done all that heavy lifting. It's really just about repaying the debt over the next 20 years. And buying well is important in all markets, especially Canberra, because Canberra's quite spread out. And so it can expand relatively easily. And I think it's really important to buy well in Canberra. And in Canberra, you need more money to buy well. I think it's probably, even more important not to make compromises in Canberra than other places just because of its density. It's not very dense as a capital city. I mean, it's a very small capital city. But anyway, that's taken me nearly 20 minutes to answer that one question. So the next question Alan's got is, should we sell the investment property? And they're torn between, they've done well, the property's done well for them, and they're torn between doing that. Most important is buy well. I think in Canberra, if you're going to buy a house, you need to be in that $2 to $3 million price bracket. Well, I think if you can get yourself in that $2 to $3 million price bracket, it opens up more opportunities, better opportunities that I think we'll look back in 20 years' time and go, yeah, that was superior. So I'd be inclined to sell the Ipswich property. It doesn't have any material gearing against it, $180,000 loan against a $625,000 property. So you're not going to get any negative gearing benefits. Not the reason to do it, but I'm saying a low geared investment means that there's not enough gearing to magnify the return to make it worthwhile. You're going to take a hit in terms of capital gains tax. But again, the way I would view it is that you're taking the equity from that property and then reinvesting it in a better property that's not going to attract capital gains tax. So I don't know what your total budget looks like, but I feel like that if we indulge in that conversation, that I would probably get to the conclusion that, yeah, I would probably sell the investment property, increase the budget. And by the way, I think those observations can be equally applied to both Brisbane and Canberra property markets. And in regards to the shares, I'll probably keep them. When I added up those assets, I actually I forgot to account the investment property, interestingly enough. So I think I'd want to keep the shares because I want to have some investment assets outside super. I don't think you need to put all your eggs in one basket. If you sold the investment property, then maybe you've got about $1 million together with your net of tax and selling costs and whatever, together with your cash savings. And then if you can afford to borrow, more than $1 million, then you're kind of off to the races in terms of getting north of $2 million in terms of a budget. And I think that's more than enough, that's enough to be able to execute a strategy like this while minimizing risk. Okay, Alan, that's 22 minutes of prattling on from me. I like not only just to answer these questions, but just for the benefit of everyone, I guess, to kind of share the conversations that we have internally. Like I said, the conversation I was having with Campbell yesterday, to give everyone the benefit of that sort of insight in terms of the approach and the considerations that we might take into account. But Alan, I hope that's useful for you and good luck with it all. Okay, next question is from Anna, or I should say questions. There's a lot of them. So there's two big questions today. Anyway, Anna's kindly written some lovely feedback. I feel like it would be too egotistical of me to read out that one since I read out Alan's previous one, but thank you for your great feedback, Anna. Okay, there's some questions. Actually, I'll just give a brief overview. Anna's PAYG, works in financial services in Melbourne, 44 years old, single, no dependents. Recently went through a redundancy situation and she went back to public practice, which means she took a bit of a haircut in terms of pay. Because she's in financial services, she feels like sometimes it's a disadvantage because you've got too much knowledge. I hear I'll talk about that in a second. Current salary is about 120,000. Supers in Vanguard, high growth option. She's sort of home investing, which I must have spoken about, or maybe it's Campbell in episode 382. So has quite a high. The home's worth 750. The mortgage against it is 650, so quite high gearing, but looking at it as a way of building wealth. Also, she owns an apartment in Southbank worth 420,000. She likes the location, thinks maybe that's a downsizer, but it's an investment at the moment, and has a few assets outside super, some direct shares, Vanguard managed fund, and an emergency sort of cash fund, and so forth. So that's her situation. And the questions that she's got, which I think I can answer. Of course, it's not advice, it's just information, but I think I can answer in a way that will benefit everyone or most people listening. So the first one is, for a PAYG employee, when would setting up a family trust structure be beneficial? Is there a trigger level of income or surplus cash to consider establishing a family trust? Would a family trust still be beneficial for a single person? Okay, so I've spoken about this previously. Normally, I like to envisage that we'll have about $1 million, or at least close to somewhere that vicinity, in the next decade to justify having a family trust. Because if the balance is relatively low, then in dollar terms, the income and capital gains from that portfolio are relatively low too. And so the benefit of a family trust is that we can distribute, discretionary to anyone, including into a company. But, of course, if the income and capital gains are relatively small, then the benefit is relatively small as well. So portfolio size is a major consideration, and that's really a function of how much are we investing on a regular basis versus what is the balance today. Of course, we need to think about, irrespective of size, we need to think about how will this family trust behave in the future. So there's two parts to that. The first one is that who will we distribute to over the next 10, 20, 30, 40 years? And then secondly, is there an estate planning benefit of having a family trust? So the common situation would be, we've got two spouses. One spouse typically has a materially higher income. So, and then we might have young children. So we can distribute $416, big deal, to the kids while they're under 18 and not pay any tax. And it's not a reason to establish a family trust, by the way, just something to mention. So in a typical situation, we might say, okay, we're going to distribute to the wife or to a corporate beneficiary. So we're going to cap the tax rate at 30%. When the kids are older, and particularly if they're at uni and so forth, we can distribute to them at that stage. And in the future, when we stop working and our incomes, our earned income is zero, or the balance changes between spouses, we can use the family trust to kind of balance that up and do a bit of tax planning. And that changes, by the way. I've had a client for more than 20 years, I'm pretty sure. And for a lot of that time, the husband was the sole income earner. The husband's retired, and now the wife's gone back to work because she wanted to re-enter the workforce, not for financial reasons, but for her own personal reasons. So it can change over a person's life in terms of who the predominant income earner is, and a family trust can accommodate that. In terms of estate planning benefits, of course, a family trust gets to exist for 80 years before it has to fully vest. So really, the family trust is going to last longer than you, and it's a nice way of kind of firstly handing over control of financial management before you pass, and then a way of then your beneficiaries taking over that pool of assets after you pass away. So there's some estate planning benefits in there as well. Would I use a family trust for a single person? Well, you're single today. Who knows what the future holds, right? I mean, really, genuinely, who knows? So that's the difficult thing. And I think, and I mentioned this before, I think on reflection, from past decisions that I made more than a decade ago for clients that have portfolios in personal names, it's more often that I wish I put it in a family trust than less often. So I think sometimes I've been too focused on reducing cost and complexity. And I think looking back, I think I would have established Auntie when we first started the investing. Now, Anna's got a large home loan, relatively large relative to her income. She's got an investment property that's slightly negative cash flow that she says will be sort of turning positive cash flow in the near term. And I can't see that unless it has a massive change in circumstances, that she's going to be turn around and start investing $10,000 a month into shares. I think given everything that she's told me, I wouldn't probably establish a family trust, at least not now. That's the other thing, right? By the way, I should say that quite often we meet clients that have pre-existing investments in personal names. In that situation, we might sell any investments that we aren't happy with, they haven't performed or we think are poor investments. And then what we will do is then establish a family trust and put all new capital into that family trust. So it can be a way that you don't have to establish a family trust today. You could just say, well, I'm going to start building wealth. And then maybe if my portfolio gets to two or 300,000, then I'm going to start thinking about a family trust at that point. And you can do that. And then you can gradually and strategically divest and then move those monies into the family trust. And in particular, put new capital in the family trust as well. So it's not a all or nothing decision at this particular time. But I think, if you said, I'm a single person, I will continue to be single, and I don't have anyone else I can distribute to, like self-funded retiree parents, siblings that have a low income, and you have to get some advice around these called Section 100A issues. But if there's genuinely no one else to distribute to, then you probably don't need a family trust. Second question, which I really love, is for a PAYG employee, what are the benefits of building wealth via a family trust structure and super fund versus establishing a self-managed super fund through an advisor? And the third question, and these are interrelated, when is it worthwhile to set up a self-managed super fund? I read that ASIC was starting to regulate the minimum balances for super of 200,000 due to the collapse of First Guardian. And just to put a little bit of context around this, Anna went and got some advice from an advisor, and the advisor came back with the idea of establishing a self-managed super fund and buying a residential property and then investing in shares. And the advisor wanted some more money and she wanted to see the modeling and so forth. So, Anna, I'll remind you that I recorded episode 342, where I looked at using super to invest in property, using the gearing and so forth. And the conclusion there was the tax benefits are just the same as it is investing in property outside of super, because the negative gearing benefits are lower inside super. And those lower negative gearing benefits offset the benefit of nil capital gains tax. So just generally speaking, don't be attracted to doing that inside super because of the tax benefits. Certainly it adds gearing, but also adds more complexity. And so I tend to like gearing outside of super. You've got a South Bank apartment, you've got your home loan. I know that's for a home, but it's all gearing into your overall asset base. Just be careful, be careful about self-managed super fund recommendations. I don't know if I would be as blatant to say it's a red flag, but let me put it this way. I can't remember the last time we as a business, that is not only just me, but any advisor in Pro Solution recommended a client go and establish a self-managed super fund. Quite often we will inherit clients with self-managed super funds, and I would say with a high level of confidence that we would wind up more self-managed super funds than we would establish. And I think hopefully that gives you a sense of whether it's necessary. I think with wrap platforms, and I've spoken about the benefits, the capital gains tax benefits of wrap platforms and self-managed super, that they both have the same benefit. So with wrap platforms today and potentially an investment company or a family trust, depending on the nature of your situation, that's all you need. Keep it nice and simple. That's all you need. You do need a self-managed super fund if you're going to invest in direct property. That's the only way to do it. But I just be very cautious about doing that. I think it only appeals in limited circumstances. Full disclosure, I have a self-managed super fund. In fact, when I married my wife, she had one, so I inherited it. But my super's always been on a wrap platform, and then I consolidated into the super fund. I also do own property in my self-managed super fund, by the way. So my advice isn't just about sort of a catch-all situation. There's a bit of a uniqueness there that I'm not necessarily willing to share, at least not in this today's podcast. But I just wanted to say that just to demonstrate. But look, of course, for me to run a self-managed super fund, is more cost effective than most people, as you would imagine. And anyway, there's a long history there around why that exists. But I just wanted to point it out just from a full disclosure perspective, because normally I like to say I eat my own cooking in terms of I follow my own advice, and that is absolutely true. But my situation's a little bit different that necessitates it. So I think what it shows is it's not a catch-all. There are situations where a self-managed super fund might be, in fact, the smartest avenue, but I would just be really cautious about that. And maybe it's a red flag to get a second opinion, actually, if I'm just sort of thinking about it, because I think to my mind, it's such a minority situation, a small sort of cohort of situations that would make it worthwhile to establish a self-managed super fund. And I think if we're working on probabilities, there's a higher probability you're getting bad advice. So maybe that's the red flag, is to get a second opinion. If you go and see an advisor that says go and establish a self-managed super fund, don't immediately just assume that advisor is not trustworthy. Just get a second opinion. I think that would be really the best approach. And look, I would say most great advisors hate dodgy advisors. So if you rang up a good advisor and said, hey, can I have 10 minutes? I'm just going to explain my situation and you can tell me whether it sounds right to you or not. Most decent financial advisors are happy to oblige in that situation. There's two more questions. The next question is, any thoughts about switching to the life cycle investment option within Vanguard Super? So just to provide a little commentary around that, one of the challenges that super funds have with members is lack of engagement, in that people don't really care about their super, don't look at it, don't think about it. And so one way of dealing with that risk is establishing life cycle investment options, which means that if you were born in the 1980s, this is your asset allocation. If you were born in the 2000s, this is what your asset allocation will be. And so as you get older, your asset allocation automatically changes as you fall into a different, as you go from your 40s into your 50s, into your 60s and so on. And that's what's called life cycle investment option, and the thesis behind that is that the closer you get to retirement, the less risk you should take. I mean, I don't know about that. It's a little bit like Campbell's podcast last month about how much we're investing in the Australian share market. There is this conventional wisdom out there that I think needs to be interrogated and challenged. But with respect to Vanguard Super specifically, I find their life cycle options are way too conservative. So if you look at a life cycle option for someone they're born in the 70s, for example, that might be in their 50s at the moment, maybe 60s, whatever, 1960s, they're in their 50s. It's really conservative, in terms of the asset allocation. So no, I say stick with, you're in high growth at the moment, stick with high growth. You're 44 years old. You've got at least 15-year time horizon. So just be careful. The life cycles are good, but just be careful about how the asset allocation changes and actually whether you want your asset allocation to change too. Final question, which I really probably don't have much time for, but when is engaging a financial advisor worthwhile? Maybe I should do an episode on that, because that's a really complex question with a lot of moving parts. I think the short answer is when you can't figure out the next best move yourself with a high level of confidence. So for Anna, for example, I would imagine that her home loan's absorbing a lot of her cash flow. I'm not sure about the South Bank apartment, because it's great to keep the property as a downsizer, but if you're not going to downsize for 20 years, then what are you missing out in terms of the missed growth over the next 20-year period? Maybe, for example, Anna might be better off selling the South Bank apartment and replacing it with a better quality asset, although, she might be challenged from a borrowing capacity perspective. So if you can't sell an underperforming apartment and get a much better apartment, then maybe you're better off just sticking with that one, and hopefully, in a rising tide, all ships rise. So if we see a growth cycle in Melbourne and we're seeing a reduction of supply of new apartments, maybe she'll see some growth in that property. I'll leave it there, because I know I'm well over time and I've only answered 2 questions. So apologies for that. But look, as I said, I like to answer these questions from the perspective of, everyone getting some sort of insight and benefit. And tomorrow's episode, I'm going to talk about non-bank lenders. So the difference between bank and non-bank lenders, and why non-bank lenders today, for a lot of borrowers, have a much higher borrowing capacity, and how impactful that can be to cast that net a little bit wider than you might have traditionally done in terms of the brand names that you're, talking to or considering through your broker in terms of helping you enact or implement your financial strategy. Okay, until tomorrow. Bye for now. And before you go, if you enjoyed this episode, please share it with someone that you think will get value from it. And if you have a moment, leave a rating or review on Apple Podcasts or Spotify, as it really helps more people find the show. If you have a question you'd like me to answer in the next Q&A episode, email it to questions@investopoly.com.au. And if you'd like to learn about my new book, Wealth by Design, which is out in a few months' time, head over to investopoly.com.au/book. The link is also in the show notes. And you can also register for the pre-order offer, which is an AI tool that you can use to get more personalized value out of this podcast. Thanks for listening.